Testing 1 2 1 2. Good evening, good afternoon, good morning. Am I audible?
Yeah, good evening. You're audible.
Thank you, Bruno. Welcome. We are just waiting
Yeah, thank
for
you.
everybody else to come in. 6:33 in time. Let's give it a few minutes and then we'll start shortly. To get your questions or comments ready. We'll start with those. Let's say 6:35, which is 2 minutes, so just under 2 minutes from now. I think it'll be safe to say we can start. I'll see you just now.
Okay.
Good evening. Good evening, everybody. I trust we are all well. Let's get this party started. Just confirm if the audio is nice and clear, if you can hear me.
Yes, we can. Thank you.
Thank you. I think let's start with the usual questions, if any, or comments. Are there any questions or comments? None?
Yeah, good evening.
Good evening, bro.
Yeah. I don't know. There's something that I actually be. Please, sorry, just ignore the background noise. My kids, they are on it.
Yeah, no. Understood.
Yeah. So there's something I've actually be wanted to like confirm. Sometimes I realize that when certain news comes out and then if they are not in line with technicals in a way, it doesn't obey, the market doesn't obey the news. So I don't know if that is true or if I'm the one that doesn't understand the news. Because take for instance, now these are related news that came out this afternoon.
Yeah.
I think it was only the month that was in favor of the dollar, but the others were actually against it. But I was surprised to see that GPUSD was actually selling from that point.
Yes.
So I don't know if you could throw more light on why it was actually so, if it was good or it was just purely technicals.
Yeah, no, thanks. That's a fantastic question. Yes. I always say you need to be mindful of technical or price action. There are, key turning points in the market where the big boys and girls might not be willing to push price beyond that at that particular time. Sometimes what you might witness in the market is actually what we call front running the move, right? And so when the actual data comes out, they do the opposite. And retail traders tend to want to engage the data as it comes out, right? The data might suggest that it's in favor of the dollar you want to buy, but then, the big boys and girls have been in that trade already. They've been buying in anticipation that the data will come out as it did. So when it does indeed come out as they anticipated, they will take profit and look for fair value in the market before they continue with the trade, right? And so that catches you off guard as a retail trader because you've just jumped into a buy, but the market is selling, right? So let's see, what data was it? Retail sales, was it?
Yeah, the retail sales. Yeah.
Retail sales. Let's see, because I haven't been in front of my PC for the day. Retail sales. Let's come down 0.4 to 0.1, 1.1. That's core. Core basically is the data that is less volatile according to central banks. That's the kind of data that they like to look at. So let's see if, let's just remind, so core basically excludes the sales of vehicles, automobiles, trucks, anything automobile. It excludes that from the stats. Okay, so that has come down. Okay. 1.1, which is the headline, month-on-month retail sales, also from 1.1 to 0.1. That definitely would be,
though is lower, but not as low as the forecast.
Well, yes, 100%, right? But I think if there's anything that holds more weight, it is the core. Yes, they're equally important. They're in red, but I say core would hold more weight because that's the data that the Fed pays more attention to, the less volatile data, according to them. So we've definitely seen a drop on that one. And then the retail one, yes, it's not as low as anticipated or forecasted, but it dropped nevertheless. Now, I always say we want to compare apples with apples. Fine, predictions are just that. Forecasts are literally just that, forecasts. So I want to what I mean by comparing apples with apples, I want to compare the
Yeah.
previous number with the actual number that's just been released. And now that's proper data. It gives me, it paints a much clearer picture, if I can put it that way. Does that make sense, guys?
I didn't get that. Come again. I
So
didn't get that.
okay, so I always compare the previous data, for example, 1.1, with the actual data. Sure, the forecast, counts, but it's just that it's a forecast, what we want to compare it with at the end of the day is apples with apples. What was it last month and what is it this month, right? And that's where we can see
Yeah.
or gauge exactly the economic conditions, right? So 1.1 previously to 0.1, definitely a decline. Yes, not as bad as what they had anticipated, but bad nevertheless. It's still a decline. And that's why
Exactly.
sometimes,
It's bad.
yes, it's bad
Yeah.
indeed, right? And but now sometimes it gets confusing because these numbers come out in red and green. That green number as 0.1, where the cursor is simply in green because it is higher than the forecast. So it wasn't as bad as they thought it would be. And that's why it comes out as green. But it's not any better than last month. It's a massive decline, if anything, from last month, right? It's a
Yes, it is.
massive decline.
Yeah.
So what's really going on? Because this data here is, should, it's a reflection on the US economy. And any bad data, how would you reflect or how would you re-engage this type of data on the actual charts? What would you want to do with the dollar? Would you want to buy it or sell it? Would you want to buy the
Ideally, with
dollar?
this kind of data, you'd want to sell the dollar.
Exactly. You want to sell the dollar, right?
Yeah.
That reflects your disappointment or your concern about the economic data. That is
Exactly. Yeah.
what logic dictates, right? So you would definitely want to dump it. But is it really being dumped at this current moment? Let's see.
Yep. It's not.
It's not, right? But I looked at
It's
this
not.
chart. I looked at the dollar index early hours of this morning. And I think I've got the answer for you. And I said to somebody I was talking to in I think he's in Uganda, I said, best you just sit on your hands. Don't do anything. You're not compelled to trade. If you don't trade, you don't lose money. This is where I don't want to engage the chart. Okay, let me see. Where is the drawing? Let me just change my, I think I was using this one here. Was I? Okay. Let's look at the second chart maybe. No, I lie. I know exactly where it is. It's the third one. 1, 2, 3. The time frame is incorrect. I think I need to be on a higher time frame. There's my drawing. There it is. Let's put it on a 4-hourly chart so we can see it better. So if you look at the dollar index here, we have been in a risk-on environment. Do you know what risk-on and risk-off is? Risk-on, risk-off?
Yes. So no more risk on this.
Uh,
Yeah.
just explain it
Risk on
quickly.
is when they move to USD.
Risk-on is when?
like when traders tend to move to USD, like
yeah,
the
buying
safe haven currency.
Risk on is basically, as the word suggests, on. So we are taking on risk. And this is basically when we actually prefer riskier assets compared to safer, well, against safer ones, right? That is a risk on sentiment. So risk on, remember, we've got three safe haven currencies. We've got the dollar, we've got the Swiss franc, we've got the Japanese yen. Under any situation that might spell out a concern, we are likely to go risk off, right? And so when we are risk off, we then go for those currencies: the dollar, the Swiss franc, the yen. We rather buy those. Basically, in other words, we are buying the bonds. Okay. If for those who are working, I think they might be familiar with how their retirement annuity, or how it's set up, right? So when you're quite young, you've got usually about a 70-30 split. 70% it's riskier assets which yield exponential returns. 30% tends to be bonds. So you'll be invested about 30% in bonds. They are considered very safe, but they don't yield the exponential returns. It's nothing to write home about, but it's safe. It does definitely yield returns over time. And then as you near that retirement age, over time, it's going to be rebalanced, right? You will actually have, closer to your retirement, you'll probably have 30% of, riskier assets. We're talking about bonds here. We're talking about stocks here, right? Stocks, those are riskier asset classes, and other stuff that might be classified as risky. And then, and then 70% would be then bonds. This is when you're near retirement. I think the logic behind it makes sense. You wouldn't want to be heavily invested in riskier assets where you could literally wipe out more than half of your retirement fund close to your retirement age. Does that make sense? So when it comes to trading, there are times where we feel now, when we say we opt for cash, it's basically when we don't execute any trades, or we rather opt for the currencies, the safe haven currencies, the dollar, the yen, and the Swiss franc, right? That is risk off. Risk on, we're selling those ones. We're selling the dollar, we're selling the yen, we're selling the Swiss franc, and we're going for riskier assets. So we're going for our indices, our beloved indices: Nasdaq, Dow Jones, S&P 500, DAX, German DAX, you get it, Nikkei. So that's when we say we are risk on. Now we have been risk on because risk on basically means we're selling that dollar currency. We've been risk on.
You're selling the dollar, exactly.
Right? But now we've gotten to a point, we last saw this back last year in July. Now, this is August, almost the same time frame, or same time, a different year. Same month, a different year. Let me put it that way. Almost the same month, different year. We rebounded at the very same place. This was month end, right? And when I was talking to those before you started, we said we're going into September. September has a tendency to be a risk off month, right? It tends to be a risk off month because June, July, August, I'm talking seasonality now. June, July, August, that tends to be a risk on time, right? And June, July, August, some of us in the Southern Hemisphere, are we in the Southern Hemisphere? Yes. It's winter time, right? I just need to make sure I wasn't listening quite closely in geography. So we're in the Southern Hemisphere. It's winter time. So, we're not really out and about and really spending a lot at that time. But in the Northern Hemisphere, which is the US and other countries, it's summer holidays. spending goes up, aggregate demand, increases, remember, and that economy, about 70% of it is made up by services. The GDP, it contributes about 70% to GDP. So there's a lot of, hotel stays, restaurants, services, all that stuff. People are moving out and about, and that tends to be reflected on the stock market. We definitely do tend to see a risk on sentiment, which means then the dollar index from June, July, August needs to be bearish, or that's what we need to see at least. So you can see June, July, August. Those 3 months, the dollar is selling. Now I want you to go back into time after this session. Go and look at last year. Go and look at the year before and the one before. You'll see there's a pattern there. Remember I said the stock market is one big song on replay. It's that Michael Jackson song that everybody knows. You just have to pay attention, right? So we've been risk on, and September tends to be a risk off month because basically, all the big boys and girls, the smart money, hasn't really been actually engaging the market. They haven't been really moving the market. So who's been really moving the market? It's basically retail traders, you and I, okay? And also those automated trading systems, right? Owned by the banks, owned by, of course, the smart money. Let's just put it as smart money. That's what's really happening. So June, July, August actually technically doesn't have, or we don't enjoy a lot of liquidity in the market. So when they come back, these guys, from their yards, from sipping on their cocktails and whiskeys and having the best time of 3 months, when they come back, they want to look for fair value in the market. And so we become risk off. This is where they consolidate those positions that have been running. So risk off, we mean that the dollar then starts to appreciate in value. So what we had identified, or should I say, what I had identified as a potential level that we need to come back into is this one here. It was a significant level of support. We had a little bit of a fake out, came back into it, and then eventually violated. We never did what I spoke about last week. When we violate a level, we need to see role reversal for us to be a part of that move. So we have violated, and it made sense that we are at a key level of support. It's month end. We're going into September. We needed to be here at least up until tomorrow, which is the 18th, which is a very, very, very big trading day tomorrow. A very significant event is taking place tomorrow. What's going on? Does anybody have an idea?
The
Interest rate.
interest rates.
Exactly. Interest rates by the FOMC. Right? Interest rates by the FOMC, Federal Market Open Committee. Right? So these are members of the central bank who will deliberate and vote and make decisions on the interest rates and various other monetary policy tools that they have at their disposal. So, of course, well, I guess I might as well, I'm deviating from what I wanted to do, but I would be doing it a disservice by not explaining further, right? So I might as well continue on this topic on seasonality. So seasonality, I've already told you or given an idea that from June to August, what happens, right? We are risk on. In other words, the dollar sells. And if the dollar is selling, what's going up on the other hand? What would you be buying? If the dollar is selling,
Buying GBP USD, USD.
You're buying
Gold.
GBP USD.
Gold.
You're buying gold, XAU USD.
Buying gold. Buying Euro USD.
I beg your pardon?
Euro.
USD.
Buying a euro.
Euro USD. you would be buying your NASDAQ, buying your Dow Jones, buying your S&P 500. DEX. DEX is what? DEX? Is it DEX or DAX?
DX.
Right? You're buying your German DEX as well. All these, it's an easy buy. You can do these things with your eyes closed. And I always say, you know, I think many have heard it. I always say, it's, what's the, sorry, 1 second. Okay, sorry about that. So I've always said this, if you know, if what you don't know doesn't exist, right? So now that you know, you don't have to always be searching for this magic wand. There is none, right? There's no magic wand. It's just for you to enjoy success in the in this industry, you need that information, right? Now that you have it, you know exactly what to do, and you do it with confidence. You know what to do it, what to do, and when to do it. Rather, let me put it that way. So June, July,
Okay.
August.
Can I ask a question?
Yeah, go ahead.
The dollar index, as you're saying, is at key levels. Like now, it's on support. Now, the understanding that I have that has been coming from these lessons is that if they cut the interest rate, the dollar, the risk may be on. Now, what happens when it's already at that key level? I mean, how do you know if it's gonna, the move will be strong enough to violate if you want to front run the move?
Front running that move, you're already late, right?
You are late.
You're
Okay.
late. Yeah. You know, the people that you invite and say, come and have a barbecue, a braai with me. We start at 1 p.m. and then they come at 6 p.m. and they expect meat and drinks. It's done. The party's over. You see? So this is
Why do you say that? Is it because it's at support? It's already at
exactly.
support.
We are already there. The target has been reached. Right?
So
It
what's
leaves
likely to
last
happen
week.
tomorrow? Yeah, what's likely to happen then tomorrow?
Thank you.
Yeah.
So there are two scenarios, and nobody has that crystal ball, right?
Sure.
And we don't
Sure.
have the type of money that could move the markets. Of course,
Yeah.
one thing that we can agree on is there's definitely going to be an interest rate cut, no less
Yeah.
than 25 basis points.
Yes.
The one that we can debate is the probability of a 50 basis points. That one, right now, there's a tool that we use, of course, to gauge the sentiment on this very particular topic. I might as well show you that. It is the CME FedWatch tool, right? This is a survey that is conducted. This is all the smart money. So let's see if I can get it to refresh. Hopefully it will open. I think yesterday when I checked, there was a 60% probability for 50 basis points cut on interest rates, right? And this probability increased after last week's data, which we need to then look at. Last week's data, we had inflation and PPI, basically inflation data, right? We had producer price index and we also had CPI. And when the data was released, it pushed up that probability over 50, a 50 basis point cut. Let's see where it is right now. It's now sitting at 65. So a lot of market participants out there anticipate that the Fed is going to cut by 50 basis points tomorrow. I know it's a little confusing for many. They haven't seen this, I'm yet to come back. Like I said, I did deviate a bit, right? But this is the current range on the interest rates. Okay, it's ranging between 500 and 525 basis points, right? 500 and 525. No, sorry, I lie. I'm confusing you there. The interest rate right now is my pen. We are sitting between, let me try and write this down. If this thing will allow me. Oh, no, it's in white. That's why. There we go. I think I changed it. 500. Hey, bear with me. We are ranging between 525 and 550. This is where we are currently. Okay. Now, what we know it as ordinary traders, we are sitting here. You go to any website, it will show you that it is 5.5%. That's the interest rate in the US. So this here, 35% expect that range to move from 5.5 to 5.25. I'm just simplifying it for you. Right? Expecting it to move from 5.5, or rather, let's do it this way. This one, 5.5 to 525. That is a 25 basis point cut. 35%. Only 35% believe that that's what we're going to get. And just if you look at a couple of weeks ago, it was most who were believing that we're going to get the 25% and not 50%. Now, that has shifted in the last week. We've got now 65 saying, no, we will end up at 5%. So in other words, we're going to get a 50 basis point cut. 5.00. Currently 5.50. That's where we are. So that is a 50 basis points cut that is currently being priced in, or that was being priced into the market, right? So the smart money, hence I say we are late. The smart money has been in the trade at least, and last week was last week. What was last week? Last week was, yeah, Monday. Last week, Monday was the 12th, I think. So we can see we went all the way. No, I mean, this was August. I'm looking at the wrong thing. Hold on.
Yeah, that was August.
Yeah, no, we're in September now. So last week, what was last week? Last week, Monday. There we go. We can see we went a little sideways for a couple of days, did a double top, and then just came all the way down, closing into Friday. Monday and Tuesday, basically today, if we zoom into this picture, it's been a sideways move, with the exception of a few hours ago, the market pushing ever so slightly to the upside, right? Instead of pushing down, they rather said, okay, not enough sellers to push. If there's not enough sellers to push the price down, bulls will be in control. To answer your question there, we are at a key level of support. They've been pricing in that move. They are at a key level. Now, what's going to happen tomorrow? Either there will be a willingness and the liquidity to do so, to push and break below this price point, this key support level, upon cutting those interest rates. We're either going to break. Don't rush into the trade. I always say, sit on the sidelines, okay? Because basics, which you must always remember. Who is at support? There's bulls and bears. Who wants to be buying? Who wants to be selling at this point? Who has the best chance? Who's got the best price? to do what they want to do here.
Bulls.
Is it bulls or bears?
The
It's
bulls.
bulls. It's bulls, right? Bulls buy low. Bears sell high. So bulls, we are in bullish territory right now. We are in.
But hang on, level. We have a fundamental bias.
Yes.
That can rock the boat. So that's why we need to stand on the sideline, because that theory, doesn't that theory only applies under normal circumstances?
No. You
No.
you just said it. This is where you sit on your hands and watch. Let price do what it needs to do. Because you know, fundamentals are dictating that you should be selling. But you're selling where you shouldn't be selling. It's not fair value for you.
And I think this actually gave me an insight to why it actually reacted the way it did today.
Exactly. Because the
even
data
though
was
the
saying
news
sell. The data was saying it's bad, I need to sell the dollar. And then what happened? It wiped out many retail traders because they came in and sold where they were not supposed to sell. They went to
exactly. No, it came in my favor though, because I was looking forward to short today, pound the US.
So definitely, guys, you sit on your hands with this one. Like I always say, you don't ever feel like you're missing out on anything when it comes to trading. There are ample opportunities to make a return and ample opportunities to lose your money, right? The market has no mercy, right? So you rather don't ever feel like you're missing out. People are, sharing, their screenshots. It's blue. People are screaming. They're happy. It's all a facade, man. It's no. You don't fall into that. You need to apply logic and say, you know what? The fundamental picture here is quite clear. We need to see a deterioration of a dollar price. The dollar needs to sell, but I can't be selling at this point. It doesn't make sense. So when I come in and be a part of this party, right, I need to then see what I've said last week. We need to see, okay, let's make it right. We need to see this happen, right? We need to see that happen tomorrow. Then we need to see price cool off. We need to see the dust settle, because this is going to be a knee-jerk reaction tomorrow, okay? But we will be violating a significant level. Now, many, when they see that happen and price is moving rapidly fast, it's down here. What do you want to do? I'm missing out. Surely I can catch it. It's a trade that you did not plan, and you should not be trading it. You plan the trade, and you trade the plan. So when you go in here, you're exposing yourself to risk, and then it goes a little and then you don't know, and then it goes and then you're out. You were in the sell here. You saw a bit of profit. You didn't know, should I go out, should I stay? Because you didn't do the work, you didn't do the homework first, and then it comes back up again. You're trapped in that sell trade. You're right, supposed to be a sell, but you didn't sell it at the right place. Okay, so we want to see this happen. Role reversal. This is where we will come in. This is where we will come in. 100, this is where we come in. 109, I think it is. Right? That's where we will come in. Or let's just simply say 100, because this is where the current price is right now. Let's say 100. Wait, right here. This is where we're going to come in after seeing role reversal. Then we have a high probability setup. We trade it with much more confidence, with less anxiety. Then we set it to the downside. And if this is selling, because most of us honestly don't trade the dollar index, then what are we doing on gold? We're buying it. Nasdaq, we're buying it. Dow Jones, we're buying it. GBP, USD, we're buying EU, we're buying. You get it?
Yes.
USD, JPY, we're selling. That's what we're doing. And now that I've mentioned USD, JPY, that is a perfect storm brewing, USD, JPY, because the Bank of Japan is going the opposite direction with their monetary policy. They are hiking interest rates. So their currency is appreciating. And these guys tomorrow will be confirming that their currency is going to start being weak. So USD JPY, you sell it with your eyes closed or open. It's up to you. But you know the direction that it should take. But you don't simply just go into a chart and say, this is the fundamental bias, I'm just selling it. No, price, it needs to make sense in terms of price action. You want to have a clear correlation between price action and the fundamentals. So
can I summarize what I'm hearing?
Yeah.
So what you are saying is that in terms of logic, at support, we find the bulls unless the level gets violated. 100%. That's what you're saying.
100%.
At resistance, we find the bears unless the resistance violent is violated.
100%. That is exactly what I'm saying, right?
Okay.
That is exactly what I'm saying. Now, remember, earlier said they've been in the trade, right?
Yeah.
They've been in the trade. They know there's a few hours, arguably less than 24 hours, before that major decision that's going to be made. It's going to be the biggest trading day, one of the biggest anyway, right? Tomorrow. So because we haven't seen interest rate cuts in the US in 4 years. The last time was back in 2020. So everybody's waiting in anticipation to see this happen. So what's the second scenario here is because they've been in that trade, when the data is released tomorrow, the first scenario was we're going to violate, then we will wait for this to happen for us to be in this trade here to continue. That's the first scenario. They either will do that, that's the type of price action we're going to observe tomorrow, or they will take profit and go and correct that imbalance in the market. Fair value. Now, a lot of retail traders will be sweating bullets if that happens. Because remember, all they know is, interest rate low, we sell. So they'll be selling at this point, expecting to see this, but the market then does this. There goes their accounts. Their accounts will be gone. You follow?
Yeah.
So either first scenario, this happens, or second scenario, they've been in the trade already. And when the actual data comes out, they'll just simply take profit and look for fair value. Come into the spot, and then, so they'll squeeze out all those sellers and then sell it.
Yep.
So hence I say,
wait.
Wait.
We must wait.
Wait, let price action dictate to us what to do. The fundamentals will be clear. They're quite clear. We know what's going to happen. We just simply want price action to be clear. I think for us to definitely see a violation of this level tomorrow, it could be based on the 50%, the 50 basis points coming out as real. Then I think we're definitely going to see an overreaction in the market. There's going to be a lot of engagement on that, a lot of reaction, I must say, right?
Yeah, because even if it is 0.25, it's still higher than that of United Kingdom. So
Yes,
you're right.
100%. Now, also, I saw an article shared by one of my traders, as was saying the headline was something along the lines of Congress, which is government in the US, sending an open letter to the Federal Reserve, basically dictating to them that they expect to see a 75 basis points cut tomorrow. Now, I don't think that's going to happen. If anything, they'll be met in the middle with the 50 basis points instead of a 25 basis points. But the Fed has always reiterated the fact that their decisions are not politically motivated or encouraged or coerced or whatever the words you want to use. They work with data, right? Because politicians are politicians and they work with data, right? So yeah, they might be appointed by Congress, Jerome Powell, but his work is he's got free reign on doing what he needs to do. He's not told this is what you have to do, right? The only thing that they don't tell him how to use the tools or how to get to a particular point. His mandate is clear, like all central banks. It's price stability and maximum employment. Create that environment, use the tools at your disposal, which is monetary policy, right? So Congress coming in or the government saying, use this particular tool in this manner. No, that's improper. I haven't seen it, right? Yeah. So, why was I? You remember we said seasonality, okay? September, we said it tends to be a risk-off month. In other words, the dollar then rises, to look for fair value. Why does it do that? The last quarter of the year, which is Q4, October, November, December tends to be risk on, right? And it tends to have a reasonable liquidity, right? Everybody's is chasing, profits, it's time constraints. We need to, so the risk on sentiment really increases October, November, December, at least up until the second week of December. So we tend to see, that's the dollar being bearish, the stock market being bullish, and gold being bullish as well. Okay, into at least the second week of December. So let's see how it's going to play out. Either we violate, we continue being risk on with no significant correction, to continue. In other words, we'll just have, right, that. And that means with gold as well, it will just continue to print new highs with no significant correction before going up. And if there's anything that you must live by, you want to find fair value in the market. If a level is violated, price must come back. That's fair value for you to be committed to the trade. But if price just continues to go and go and go, it makes it a little hard, especially if that price or that asset that you're trading is in what we call price discovery. It has never been where it is currently. It's at all-time highs, new record highs. That makes me what we call risk averse, right? This is where we anticipate one way or the other. We know that there has to be a correction. We just simply don't know. We are in uncharted territory. You can't simply buy into a place where you've never been. The type of trades that I enjoy are the ones of fair value, where price has been. If I'm to buy this, I know where price could be because it's been there before. It's been there before. And when we get to those highs, I can use them as a clear level of exit, take profit level. Because there's historical data that I can work with. But if we've never been there before, I personally anyway become uncomfortable buying into that because we've never been there, right? So, for example, with gold,
yeah,
all-time highs. We hit new record highs last week and early this week as well, I think. XAU, USD. My favorite 70% of my trades are made up by gold. Yeah, gold just simply pays, something that I like to engage. I understand the price action very well. Quick drawings. Okay, I've got the drawings there. There we go. I did this morning as well. 25.30 was the high. We broke it last week. 25.89, give or take, is where we found resistance. We've gone sideways for the last 2 days. And because of this data today, we've basically violated that little support because we've gone sideways. We've violated that little support. We've never been here before. This was the all-time high, 25.31. A violation. After violation, what do we expect?
The retest.
Thank you. So once we get to 25.30s, then we feel comfortable to buy it. This will be a value trade because we've been here. So we know what we are buying into. And when we get here, we become risk averse. If we had 3 or 4 or 5 trades, we start to consolidate those positions. We take our profit and maybe we risk 1 trade. Adjust the stop loss and let the sucker run, as we would say.
Yeah.
Okay?
Okay.
Yeah. So let us see how it's going to play out. But what I do dream of or hope for rather, is to see the market ultimately take profit or consolidate their positions once that Fed cuts those interest rates. I'm hoping to see a strong dollar, confusing all the retail traders, pushing into the zone, giving us fair value so that we can ride this trade into the second week of December. If we see a consolidation, or rather price, a corrective buy on the dollar index, pushing into the 104s, that means the dollar index, the gold chart that we've just looked at will push at least all the way to the 25.30s. And then we'll be comfortable to become risk on. Nice and clear?
Yeah.
Okay.
Yeah.
Okay.
Yeah.
Yep,
Okay.
nice one.
It's okay.
Okay. No, that's a fantastic question. Fantastic question. Yeah, we really went into that one. And what did I want to talk about? Or rather, let me ask, maybe there are other questions or a follow-up question. Maybe somebody needs clarity. Or a completely different question. So, yeah, last week, we had that. No, let me not do that, because then I'll be jumping steps here. All right, but I'll just mention it. So last week we had CPI. It's a measure of inflation. Okay, I think tomorrow then I'll talk properly about, inflation versus interest rates to bring about clarity for maybe some who are lost completely, right? But CPI is one measure of inflation. And remember, core, there's data that will always say core. Core is the one that central banks look at. Basically, that's important to them. So we've seen a decline in inflation data. Now, if you look at last week, yes, we got the month-on-month data. The core nudged up, right? I think from 0.2 to 0.3. And that was a bit confusing for many, but I'm going to expand on it and show you exactly what other data experienced traders were looking at that wouldn't have likely appeared on this site here for its factory, which is used by many, right? So there is other data that suggested that indeed inflation is cooling and we need to be selling. We need to be selling who? Selling the dollar, risk on. Okay, so that's been priced in now. Okay. So let me just make sure. Last week, what did we talk about? We talked about what is forex trading, what really makes the market really move up and down. Currency pairs. Are we all okay with currency pairs? We spoke a little bit.
Yeah.
Okay. We spoke a little bit about the history of money.
We spoke about brokers, something very worrying.
Yes. We spoke about brokers, A book and B book, and the shenanigans that they play. So
they go against you. That's very worrying.
you've been warned, right? Yeah, you've been warned. But no, we always work around these things, you know. No, it's a game. As long as you know the type of game you're playing, then you know how to engage it, right? It's sad when you don't know that the game is rigged. So you know, hey, yeah, that's then Akshem, you're going nowhere slowly.
I even check leverage on mine.
Yes. And leverage, like I said, don't be afraid to use leverage, right? Don't be afraid to use leverage. I use leverage because I said it's one of the reasons why trading is so attractive, because you can turn $100 into $1,000. I think if anything, South Africa and Nigeria are known for flipping accounts, right? Which is frowned upon by many who are so-called, professional traders in various parts of the world. That's what we do. We flip accounts. We move it from 100 to 1,000 to 10,000. That's what we do. We are known for that, right? We're not going to do this whole traditional thing that's done by guys who wear suits, who are bankers, move, an account by 30% in a year. No, we move it by 1,000% in a year. That's what we do.
and, and the losing is just as bad.
Yeah, and of course, if and we lose just that. But I think I've demonstrated time and time again that you can grow your account exponentially. The one that I started on the 18th of June, that's about 500% up. It's and with very meticulous what you call this risk management. It's very much achievable. You can do so. I just want traders to get into the habit of definitely withdrawing and not letting your accounts grow.
Is that 500%? It was from 2,000 to how much now?
2,000 to 50,000 now. Currently 50.
That's more than 500%, right?
You're right. Yeah. Maybe that is maybe what? Maybe that's 5.
Maybe it's 1,000.
Yeah, it's like 5,000.
So it's really possible. I think even Rev has done this, publicly a couple of times with a $10 account, moving it to $1,000. It requires, and I love traders who can do that because it takes a lot of discipline, and you need to sit on, you need to be patient, and for you not to blow that account, that's exactly it. You need to be disciplined. You need to be patient because these are the things we used to look at when we used to fund when prop firms were not so popular and we used to fund our best traders. We would look at such things. We would look at, I'll show you what we use. We've got an automated trading journal that logs all your trades, everything that you pretty much do, right? And so we are looking at the drawdown. Yes, you will have a trader, let's say, who moved a $10 account to, let's say, 10,000. But then we look at, okay, at what cost? At what cost? What is the drawdown? How much capital did they risk to get to that point? So the one, we may have two traders who have moved $10 to 10,000, but the main thing is we're looking at what is their drawdown on each account. The one with the less drawdown, that is arguably a better trader because they risked less to get to that point, right? So don't, and when you are back testing, which is something that you have to do, you can't run away from it. You need to back test what I'm teaching you, what you're learning. And you need to work with a sizable sample, at least of no less than 100 trades executed, so that you can see whether you are going nowhere slowly or you're improving. That account is growing, right? That demo account is growing. Let's change the color, right? It's growing. It's growing. And this is basically what it's going to look like. It's not going to look like this, right? You're going to have losses. You're going to have losses, but we want to see, you know, that that yield curve go up over time. Okay, and that will definitely show you that you are managing your risk. You are patient with yourself. You want to start with the smallest demo account, not the one that they give you with $100,000. We don't have $100,000 to fund with, right? So you can easily move that $100,000 account to 1 million and say, oh yeah, I'm the best trader. None of these guys know what they're talking about. Go do that with $100, $200, $50. You'll come back and tell us, right? So small account, small demo accounts. When you start funding your real account, so many of you have real accounts, don't commit what you can't afford to lose, right? Don't commit what you can't afford to lose. $50 to some might be, money is relative. $50 to somebody might be a lot. To some might not be nothing. It's something that would have spent on a spontaneous purchase, and they don't even remember the following day or a week later what they used the $50 for. That's the kind of money that you want to commit. The money that you wouldn't really have sleepless nights over if you lose that. Okay, so yeah, we did the brokers. We showed you how to set up your profiles, how to set up your templates. The difference between, we spoke, I think, about the difference between trading and investing and how important equally are. Currency correlation. What else? Slippage. Didn't mention slippage. Checklist, of course. Yeah, right? So under our checklist, we spoke about top-down analysis. I think we need to do the top-down analysis so that we understand. I've got a nice example that I like using so that you really understand the importance of top-down analysis, why you want to do it as often as possible, right? Let me try and switch screens to a whiteboard, and we can do that. Where's my whiteboard? Share. Let's give it a sec. In the meantime, I'll be with you. Give me 30 seconds while it's still loading. Okay, thank you for holding. I see the whiteboard is not loaded yet. Okay, let's see. Let's see. I think I needed to click yes. Okay, it's a little slow. Let's give it some time. So far, no question. No. So what I really want to get out the way is the top-down analysis and risk management. We've already briefly touched on the concept of risk management by simply looking at what pips mean in monetary value once we allocate a lot size to them. How's the audio? Because my screen is now blank. I'm not too sure if I'm still online. Let me just confirm.
Yeah,
oh, there we go. Yeah, I can hear you. I can hear you. Okay. Yeah, my screen is blank. Okay, there we go. Okay, can you see the whiteboard?
Yes, we can.
Perfect, perfect. Now I'm just waiting for the annotation tools to pop up. Okay, there we go. So top-down analysis. Now this is an example that I saw years ago while trying to figure out how can I best explain top-down analysis to traders. So I'm not going to take the credit for it. I can't remember exactly where I found it, but it definitely was online. And I found and I thought this definitely is a great example. So we're gonna draw a building. Don't mind my drawing. Kindergarten, I don't know it. We've got how many time frames? How many time frames?
From 1 minute to a day, week,
I
month.
think about nine major time frames.
Right? From 1 minute to the month. So let's see. 1, 2, 3, 4, 5, 6, 7, 8. Let me extend this building of mine. We've got 9. 1, 2, 3, 4, 5, 6.
It's a $50,000 building.
I beg your pardon?
It's a $50,000 building.
Now this one is a little sketchy. I wouldn't go into such a building. 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, we've got a sketchy corporate building, but it's up. Hopefully the foundation is solid. Now, in a corporate environment, who sits where in these floors, right? Where do you find your directorship, your sales, security? Who would you put where?
The director will certainly be on the top floor.
Directors would be at the top floor. 100%. Yep. That's our monthly time frame, right? Directors would be at the top floor. Okay, 100%. So directors, the board of directors, the directors, senior directors, junior directors, sales and admin starts to trickle down. Sales and admin, whatever, all starts to go down. Now, just describe the environment up here. Up here. Describe if you've been to these in the corridors of these buildings, right? From coming down here, boom, lift opens up, you're up there. Describe the environment, the feeling that you get. What are you seeing? Describe the noise levels, the flooring, the pace of things for me.
Noiseless, calm.
Mm-hmm.
It's calm, noiseless.
Exactly. It's very quiet.
Yeah.
Smells like that Arabica coffee, nice coffee. They've got coffee machines. These guys down here don't have coffee machines. The coffee is always disappearing anyway. Somebody's stealing your lunch from the fridge. You won't find those games up here, right? So it's quiet. Tends to be proper, wooden
aesthetics.
I beg your pardon?
Proper aesthetics as
exactly. Right? The aesthetics are pleasing. Their desks, are very, very organized. In most cases, there is no papers, piles and piles of paperwork, files upon files. No. Right? You get the sense that these guys are being paid a lot of money but you don't quite get to appreciate what they're really doing in the company. You, especially if you're down here, you feel like these guys, man, they just have it easy. They're just telling everybody else what to do. Would you agree? For somebody maybe who's worked corporate?
Exactly, yeah.
Right? That's the sense that you get. And indeed, they are paid to tell you what to do. You are quite correct. And the pace is slow. Right? So these are the board of directors. We'll put it as the board of directors here. Board of directors. These are the guys who come together, you know, sit around the table. They deliberate, they discuss, they plan the direction of the company, right? All the mergers and acquisitions, all that stuff goes through them. So they set the direction for the company. If you've got a bad board of directors, geez, that's the end of the company. And I think for some of us who are in South Africa, we've seen it countless times with our SOEs, our state-owned enterprises, for the likes of Eskom, which is our power supplier, etc. We've had people who don't know what they're doing. Some are not, they have no level of education. It's just catered deployment. And that has been to the detriment of our power supply. And then now we're back to, or rather, yeah, I would say we're back to almost Stone Ages.
Now you're at the same level with Nigeria.
Now we're at the same level as Nigeria.
Yeah, we're proud to
we were
welcome
laughing
you.
at you.
We're proud to welcome you.
And we were mocking you just 20 years ago. We're like, haha, seeing it on the news. Hey,
Although, ironically, our power has actually improved this period, though.
Yes, I'm aware.
Yeah.
I'm very much aware, right? Which is fantastic. So you guys are actually now doing better than us. Well, at least well, it's a bit sketchy, but apparently we're making as well. But you get the point of board of directors, right? It's they're important. Yeah. So the monthly time frame is not to be ignored. I beg your pardon?
So I think you should mute Glorious.
Okay. Yeah. Mute if you. Yeah, there we go. So the monthly time frame, when you look at it at a glance, it looks like nothing is happening. But you really want to be paying close attention to it, especially when you are identifying key turning points in the market. And those are used the monthly time frame to establish that Euro GBP is going sideways, and it's been going sideways for the last 7 years. So we know exactly the key support and resistance levels identified at monthly. So when you get to a key level of support, which is a monthly, which was identified on such a time frame, you can't go into a sell, right? Because you are you're exposing yourself to so much risk. That's a monthly level of support. It's been respected for years on end. It has been support. And then you want to go and sell. So what you don't know doesn't exist. If you haven't been paying attention to the monthly, on the lower time frames, it might look rather insignificant and you might sell. Right? There goes your account. The higher the time frame, the more significant it is, basically. After the monthly, we've got the weekly. So the board of directors make a decision, and then they call in who? They call in the weekly and say, listen, who's the weekly? That is the MD, the managing director of the company. He listens to them, not the other way around. They give him the mandate. Okay? And they say, listen, this is what we would like to see happen in the new financial year in the new financial year for the company. And then he has to understand it, make sure it's clear. Once he understands it, he'll call in who? The 4 hourly. 4 hourly senior directors. Guys, listen about
daily first.
Oh, sorry, the daily. The daily, they call in the daily, which is our senior directors.
Yeah.
Says, listen, guys, you know, I was with the board of directors. This is exactly what they want. He needs to make sure that they understand what they need to do as well. Okay, these guys understand, and they bring in, is it the 4 hourly now?
Yeah, probably.
Which will be our junior directors. So these guys here. So all these guys here, these are in directorship. These guys here. These guys are in directorship. They are up there. Right? This is big money. This is big money.
Yeah.
The pace, slow. So in other words, these are your banks. These are your hedge funds. These are your money managers. It goes on.
Yeah.
These are the smart money, right? Smart money is here.
Yeah.
So if you're not paying close attention to these time frames and getting the sense of direction, and you're down here, down here, the staff turnover is extremely high. Every week you see somebody new. Oh, hi. Oh, okay. Oh, where are you from? Right? These guys don't change all the time. No, I was at the other company next door. Yeah, it's so bad. The treatment, we've all been here. No, it wasn't. And then the same person is out again 6 months later. No, that was a nonsense company. It's a shit company, right? So the staff turnover is high here because many don't understand. They're not in tune with what's going up here, what's going on up here. Most of these guys here don't even understand how to read a financial statement. They don't know what their company made in terms of profit for the last financial year. They couldn't even care less. All they want is their money now. Right?
Yeah.
So this is the retail traders. They are down here. And that's why 90% will lose 90% of their capital in 90 days. They're just simply not understanding what direction are the big boys and girls taking. H4 followed by H1. H1 looks like a 7 net. That's correct. H1, we'll have, let's say, our supervisors.
Superintendent, yeah, supervisors.
30, let's say, admin, maybe. Or let's say sales, maybe. Who's above, sales or admin? I don't know. Well, they're on the same level. We'll just put it as sales.
Sales.
Sure, it should be more important because they're bringing in money, right?
Yeah.
Than admin. That's my logic. I don't know. Could be wrong. Here, maybe sales and advertising. Maybe sales and advertising. Then we've got admin. And then we've got M5. We've got reception, right? Etc. Then
M1 security.
Thank you. Then we've got our security personnel, our janitors, etc. down here. The levels of noise here. That's definitely our small money, and the pace is fast.
Yeah.
So for you to be successful and move up the ranks, wherever you are here, you need to be in tune with these guys. Understand exactly where they're trying to go. Start understanding them, speak the lingo, speak the language. And then you start to move up the ranks. Right? So the same applies with our top-down analysis. We are trying to establish confluence in these timeframes. If these guys here, the smart money, the big boys and girls, are not pulling in the same direction, it's not going to work out. So we want to find or establish that confluence. In other words, when we look at the time frame these time frames here, we are trying to establish confluence. We want to see if they're telling us the same or similar thing in these time frames,
Yeah.
then we can go and do exactly what they're doing in any time frame. The time frame that you will choose to execute your trade will dictate, or will be based, or rather, on the type or the duration of the trade, right? So if you are, which we didn't really speak about anyway, we took it for granted. If you are a scalper, you can't be scalping and looking at a weekly time frame and then you say you're scalping. No, you're down here, right? You like your 1 minute, you like your 5 minutes, you like your 15 minutes, maybe sometimes even your 30. These are short-term trades. You're targeting, a shorter pip range. You're in and out of the market a couple of times throughout the day. You don't sleep with open trades, right? A day trader, maybe you're here, you're looking at the 30 minutes, 1 hour. I would say maybe even the 4 hour. Let's just put it in there. You're a day trader, right? And if you're a swing trader, which is the type of trades I like to identify, I'm always looking to find entry between the 4 hour and the 1 hour, sometimes even lower. I play those tactics. If I want that 80 entry, I might go to even 15 minutes just to confirm, did we really close above a particular level? Then I'll go in, as but mainly we are known for 1 hour and 4 hours. I'm not going to mold you into being a particular type of trader or trading in a particular style. No. I think a good trader or an experienced trader will understand that they can engage the market in any way, right? I mean, why wouldn't you want to swing and hold and target 600 pips? Why? Why would you say, no, that's not for me, right? Of course, there are times in the market where the chart might be choppy and you would have to go to lower time frames. This is usually month end, and then you might scalp it, okay? If it's not clear, you can't commit to a swing, it's not quite clear, then you're going to lower time frames, you might see something there, then you scalp it. But ideally,
Okay.
yeah, go ahead.
I think in theory, I do understand this, but I think I struggle when I'm doing this practically. Would you be able to actually show us examples practically of how
Let
to
me see.
apply the template? Because when I look at H4, I'm never sure, do I look at one candle? Do I look at the historical? So I realize that I'm not fully understanding how to apply this practically. Yeah.
What I want, traders, is the best way for you is to share your trade analysis. If you're shy to share it on the group, share it privately with me, and and attach and say, this is what I'm seeing. It looks like a potential swing trade. This is my entry, based on X, Y, and Z. If there are fundamentals to back it up, please do so. That's it will definitely help with your confidence as well. But let's look at, I want to switch. There was one I did this morning. It was what was that trade? What was that trade? What was that trade? What was that trade? I didn't jot it down. Could have been GBP, JPY, or Euro JPY. I think we looked at a couple of things the hours of this morning, and then I reviewed it, I think just at about 10 a.m. South African time. So I just want to, let's see, I'll find it. It's a little slow on my end. Share. Yeah, my Zoom is not sharing as it should. So let's give it a second. But is the audio still fine?
Yes.
Okay, perfect.
Still fine.
It just says not responding in brackets on my end. So I think I clicked it a little too many times. Let's see. Let's see. Okay, yeah, I think I really messed it up. Okay, give me a sec. Let's see if I can. Nope. Won't allow me to click on anything. Okay, but while I'm still waiting for that, so a 4-hourly time frame will be known also to some as an intraday time frame. Okay, so some might even not go as far as to the monthly time frame. I'm not saying go to, when you do your top-down analysis, to go to the monthly time frame on a daily. No, it's the picture is not going to change dramatically in a day or two. So maybe once a week you can do a thorough higher time frame analysis, top-down analysis, looking at the monthly and the weekly. But a lot of traders like myself will look at the daily, kind of encapsulates everything anyway. Look at the daily, 4-hourly, 1 hour, and we try and establish entry from that point. Why do I like swinging while this thing is still figuring itself out? Let me just confirm. Maybe I'm talking to myself. Is the audio still fine?
Yes.
Okay.
Yes.
So why do I entertain swing trades? And by the way, I never used to. Funny enough, we've done a 360, myself and Ref. Initially, at the start of it all, he used to be a swing trader. He used to love swinging. And funny enough, my other aunt, because we've had that type of support, by the way, when we started enjoying a little bit of success. They were really, in fact, not even before we started, they've always been there, right? So she's what, 70 something years old? It's only recently in the last, I think, 2-3 years, she said, "Hey, now I'm fully retired. I don't want to be even looking at charts now." But she, for the longest time, she